A single flower bulb sold for more than a house in Amsterdam, and nobody involved understood they were about to lose everything. The Dutch Golden Age 1630s. Amsterdam wasn't just wealthy, it was drunk on wealth. The city controlled global trade routes. Ships arrived daily loaded with spices, silks, and capital. Merchants had money to spend and they were looking for status symbols. What they found was a flower, not just any flower. A tulip with stripes and flames of color that seemed to defy nature itself. The tulip wasn't new to Europe. Turkish botanists had cultivated them for centuries. But in the 1590s, a virus, a real biological virus, began infecting Dutch tulip bulbs. The virus didn't kill the plant. Instead, it created something merchants found irresistible: unpredictable color patterns. A bulb might produce solid red petals one year, white the next, then striped the year after. Each variation was unique. Each variation felt precious. By 1634, demand had exploded. Not everyone could afford a mature flowering plant, but bulbs could be traded. And here's what the buyers didn't yet understand: bulbs sit dormant underground for months. You can't see what color they'll produce until they flower. You're buying a mystery. You're betting your money on a pattern that won't reveal itself for half a year. Trading system that emerged was ingenious and catastrophic. Taverns became trading floors. Merchants gathered in inns, the Prinsenhof, the White Swan, to bid on bulbs they'd never seen flower. A single bulb of the Semper Augustus variety, striped red and white, could fetch 6,000 guilders. To put that in perspective, a grand Amsterdam townhouse sold for around 3,000 guilders. A skilled craftsman earned 300 guilders per year. Buyers were betting that next season's bloom would be even more striking. They were betting that someone wealthier would pay more. They were betting that the demand curve would never flatten, and for 3 years they were right. Prices climbed month after month. Bulbs that cost 100 guilders in 1632 cost 1,000 by 1634. Men borrowed against their futures. They mortgaged land. They borrowed from each other. By February 1634, the market had split into two tiers. The official bulb market operated in spring when bulbs were physically dug up and sold. But the futures market, the tavern trade, operated year-round. Men were buying and selling contracts for bulbs still in the ground. The bulbs themselves were almost irrelevant. The money was in the transaction. Then in March 1634, something shifted. A buyer at a Haarlem tavern auction won a collection of rare bulbs. The price, 500 guilders. He looked at what he'd just purchased. He looked at his money, and he walked away from the deal. He refused to pay. What everyone didn't know yet was that this moment, this refusal, would unravel everything. The refusal triggered a cascade of doubt. If one buyer wouldn't pay, why should the next? Sellers began asking themselves the same question: what is a bulb actually worth? The answer, they realized, was nothing, or rather, it was only worth what someone else would pay. And suddenly, everyone wanted to sell at once. By May 1634, the market had collapsed. Bulbs that sold for thousands of guilders 6 months earlier couldn't find buyers at any price. The tavern traders, the men who'd bought contracts betting on perpetual growth, discovered they were holding worthless paper. The growers, who still had bulbs in the ground, discovered their inventory was suddenly unsellable. The financial toll was staggering. Historians disagree on exact numbers. Records from the period are fragmented, but conservative estimates put losses in the hundreds of thousands of guilders. Fortunes built over decades evaporated in weeks. Merchants who'd bet their land and borrowed against future crops faced ruin. Some simply walked away from their contracts and refused payment. Dutch courts, overwhelmed with disputes, eventually ruled that many contracts weren't legally binding. What made Tulip Mania the first recorded speculative bubble wasn't the flower. It was the structure of the market itself. The tavern system created leverage before leverage had a name. Buyers were trading futures contracts on assets they'd never inspected. Prices were disconnected from any fundamental value. A bulb's worth wasn't based on its rarity or beauty, but on what traders believed someone else would pay next week. It was the blueprint for every crash that followed. The South Sea bubble of 1720, the railroad speculation of the 1880s, the dot-com collapse of 2000, the housing crisis of 2008, same mechanism, different asset, men and women making decisions based on what they knew and didn't know at the time, betting that growth would continue forever, ignoring the moment when the last buyer steps out of the market. The Dutch economy recovered. The flower trade continued, but on rational terms. Tulips became a genuine horticultural industry, but the expensive, humbling lesson had been written. Markets don't care about the intrinsic value of what's being traded. They care about momentum, and momentum, by definition, always ends. The men who lost fortunes in 1634 couldn't have predicted the collapse. They had years of rising prices as evidence. They had wealthy peers betting alongside them. They had tavern merchants assuring them that demand was insatiable. They made their decisions under uncertainty with the information available to them, and they were catastrophically wrong. That's the real story of Tulip Mania, not a flower. A decision made under pressure. By people who didn't know what came next. Subscribe for the next financial catastrophe. There's a pattern buried in every crash, and we're tracking it.